Welcome everyone to the Wealth Management Review for Daniel Krug and Associates. Today's date is January 21, 2021. Welcome to the new year. And because of that, we're titling today's presentation, New Beginnings. My name is Rocky Isfan. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug and Associates. Daniel M. Krug, CEO and Senior Wealth Manager, will be joining me in this presentation. Just a reminder that this presentation is for informational and illustrative purposes only. It is not a solicitation and should not be considered investment or tax advice. If you have questions, please call the office and we will address those on an individual basis. Just a little housekeeping before we get started. We're looking at 30 to 40 minutes for the presentation. This session is a recorded session. There will not be a chat room available because this is pre-recorded, and we want to thank AssetMark for their contributions in the research in the data we are presenting. A reminder of what wealth management means to us. Overall, your investment strategy is the foundation to everything that we do, and like most wealth managers, that is the focus. However, at Daniel Krug and Associates, we find that we can really enhance your overall wealth through our advanced planning strategies, and that's in areas of things like wealth enhancement, wealth transfers, wealth protection, and charitable giving. And you can see the subjects below on that. Today's agenda, we're going to be covering what happened in 2020 with the markets. Very interesting year. We're going to be going over some of the key themes in the market, key themes that took place in portfolio strategies throughout the year. We're going to cover portfolio development, kind of what our process is to develop and customize your individualized investment strategy, and then talk about 3 different levels of portfolio management within that process. And again, because this is pre-recorded, this session will not have a Q&A at the end. So we want to come on board and say hi to everybody. Good to see you. So Dan, it's a new year.
Yes, it is. So I'm going to start this off with the 2020 market returns. So we'll kind of go through what had transpired from a return standpoint on the different markets. And so with that, let's go ahead and get started. So first thing really is a matter of a rotation in the equity markets. When you're looking at this chart, we've got our quarterly returns, and at the bottom right-hand corner, you see the key. You've got black is the benchmark. You've got green are asset classes that have tailwind returns. In other words, there was something pushing them along. And then the orange had headwind to the returns. In other words, they were really kind of fighting just to get the returns that they got. So when you're looking at the 3 areas here, you've got asset class strategy, which when you see this, the global equities really performed the best at about 14.8%. And where was the biggest problem from a headwind standpoint? Well, that was global bonds at 3.3. And you can see the black, the benchmark, looking at a blended portfolio of 60-40 split, that was averaging about 10.2%. When you look over at just equities, you can see the U.S. small cap in the 4th quarter really surged ahead. Prior to the 4th quarter, it was really lagging the equities market, but had a huge push in the last quarter. As you can see, it was up 31.3%. Overall, U.S. equities ended up in the 4th quarter, not a bad quarter at all, but really the least of all of them at 12.1%. And again, you can see the benchmark was up about 14.8 when you blend the different equities. On the bond side, the U.S. high yield was at 6.5%, and the U.S. government was really lagging at a negative 0.8. So you can see there was a bit of a rotation going on relative to the asset classes. Let's look at the rally that really kind of continued after the first quarter. You can see the devastation that the shutdown did overall in the equity markets. So again, the key on the bottom shows the US equities, it shows international, emerging markets, US bonds, international bonds, and emerging markets bonds. In the beginning, the only thing in the first quarter that really was looking good at all was the US bonds. But you can see as the recovery started to take place, you can see the equities really taking off from there. But still, overall, the emerging bonds didn't do bad year to date, and nor did the international. And the US bonds came right in there as well overall year to date. So most of you, as you look at your portfolios, are seeing that the markets really were not bad to us in 2020. However, sure looked scary for a while there, didn't it? Now, let's look at the technology and how it held up. It seems that it did the best overall, benefiting, all the different growth assets. So you've got this broken down into two charts, the Q4 and year to date. And you can see in Q4, energy took off dramatically, but year to date, it was kind of on the downside. You look at the S&P going down to the middle there, was up about 12.1% for the quarter, but still ended up 18.4 for the year. So it was quite well. Technology, the same thing, around 11.8 in the quarter, but the year was up 43, almost 44%. So it was a dynamic year to say the least. On the other side, you're looking at the asset classes, small cap, mid cap, large cap. You can see in Q4, again, small cap did well. Year to date, it was up 11.3, but the real winner was large cap, up 18.4 for the year. Now, you can drop down to the very bottom. You can see the large cap growth was really the big push for large cap stocks, and it was up 33.5%. So, you never know which asset class is going to do the best, but you want to stay diversified. But you are going to get those big outliers that really push your portfolio, and that's what we're looking for with our institutional money managers and the way they develop their portfolios. Let's look at the U.S. credit and lower quality bonds. You can see in the fourth quarter, the short-term treasury, intermediate, long-term treasury, okay. But when you look at the investment grade, high yield, and the loans, they did a bit better. You go to year to date, and really the big outlier there is the long treasuries, up 17.7. So the bond market, as you've all heard us say, is in a secular bear market. But what does that mean? Well, it means that you're going to get kind of a W effect in the bond market. You'll have times when there will be bulls, it's going up. You'll have times when there are bears, and it is going down throughout this. But effectively, the bond market long-term will end up walking sideways, very much like the S&P did from 2000 to 2015. Let's go into the next area. Do you have any thoughts on the returns from last year, Rocky?
It was an amazing year. Who would have thought in March we would be looking at any upside to this market? We were looking at going into a recession at minimum.
Yes.
But, that turned around pretty quick. So I think what we're going to do moving forward here is talk a little bit about some of the themes that played out and why things actually turned up so fast. So why don't we move on?
Okay.
And I'll take over here with the key themes that played out in the market. When we're looking at the market, the top half of this chart, we're going to talk a little bit about, put a perspective on 2020 and what actually happened in the fourth quarter. There was quite a shift, as you kind of saw in the data, but let's talk what was behind it. And then a little bit of what we're seeing, the trend moving into 2021. We're here now. what do we believe is going to be playing out that started to show up in the fourth quarter as things changed. So now hindsight is always 2020. When we look at the COVID recovery, if you remember, everybody was talking about, is this going to be a V recovery? Is this going to be a W recovery? Is it going to be a recovery? Nobody had a clue, but a lot of people were forecasting different scenarios of how that economy was and markets were going to play out. Turns out that we have actually what's called a K-shaped recovery. And what happened was, because of the shutdown, it actually created winners and losers in the marketplace. And when we look at who came out ahead, these market leaders were basically, as you see on the right side here, online businesses. The residential real estate market really took off and maintained high increases in the values. Growth, primarily driven by technology stocks, were big winners in the 2020. Again, those are the big six stocks, and the S&P really were driving the market. And the market as a whole, the indexes, seemed to do fairly well from the beginning of the year to the end of the year. The losers turned out to be your brick and mortar retail. Why? Because we were shut down and they were closed. They were basically not allowed to operate. Commercial real estate, people were working at home, and when companies were able to unload properties because they didn't need them through leases and stuff like that, they started doing that this year. Value stocks did not play out well because those are your traditional products and services that are sold in those brick and mortar stores. So they took a hit. Basically, besides six companies, the other 494 stocks in the S&P went down during the shutdown and struggled to come back. And that's because of the situations with COVID and trying to start the economy up, but then having to revert back and slow down reopening. A lot was going on due to COVID. So the economy overall really was a loser in last year. Okay, this chart, basically what we're talking about here, there's two slides here put together because they relate. On the left side, what we're showing is what happened that actually caused the recovery in much of the market and the indexes is because the Fed, as we say on the left side, cut rates in record time in 2020. And what this is comparing is three different periods when the Feds cut rates. And the first is the blue line, starting at when the Fed fund target rate was 6.5% back in 2000. If you look at that line, they started cutting rates during the tech crash of the 2000s, the dot-com crash. And it took them basically, if you look at the bottom of the graph, over 30 months to bring rates down from 6.5 down to about 1% when things flattened out in 2002 and started being in a position where they could start increasing interest rates. Look at the next section, the dark blue or black line is the 2007 to 2009 financial crisis, and the Fed fund rates were 5.25% when this started, and over the next 30 plus months, they reduced rates down to zero to really try to stimulate the economy, made borrowing very cheap, try to start investing and grow the economy. Now look at the pink or red area on your screen. The Fed rate was about only 2.25 starting out at the beginning of the year, and they immediately, inside of months, cut the Fed rate to zero. So that was reaction that was very, very fast and needed. And part of the reason, when you look now at the right side of this screen, how the markets responded. And you can see the light blue, the market took a long time to recover. The dark blue in 2007 and 2009, the market recovered a little faster, but still was basically 1,426 days to get back to even. But look at how fast in 2020 the market came back, the red line, 128 days, because of how the Fed jumped in and began to create some stimulus and some Fed policy of zero interest rates that allowed companies to go out and borrow money to maintain their business. And because of that, the market responded. The stock values came back quickly in response to that. So let's move on to the next area. Market leadership was centered on just a few stocks though. While we saw major indexes increasing, when we dissect and look into really what was going on inside the S&P, the reality is there was only 6 companies that were really taking off. Again, because they were allowed to operate during a time most of the companies were not. So the money flooded into those companies in the stock market and drove them up and also drove the indexes up. What companies are we talking about? We're talking about Facebook, Apple, Netflix, Amazon, Microsoft, and Alphabet, which is Google. And that's what these blue lines on the left side of your screen represent, is how much of a return those 6 companies had versus the rest of the S&P. Up 57.9%, while the S&P overall was up only 15.1%. And then when you look at the right side of the screen, this looks at the 20 stocks that were the best performers outside of the US. This is the ex-US companies, and I don't have the list of them, but these are the European and foreign companies that profited during COVID. They were up 47.6%, that's the blue line, versus the total international market was only up 14.1%. So again, you see that very small number of companies, both in the US and internationally, actually drove the overall indexes and kept them positive for the year. The fourth quarter, however, we saw some of this starting to change a little bit. As you can see on the left side, the other 494 companies started a comeback through October through December of 46.6%. So the rest of the S&P started to participate in this market growth, and we believe that is going to continue into 2021. So that's one of our themes, is that other companies now, with the COVID situation, with the vaccine coming out, we believe that these other companies are going to be able to get back on track and bring some of the performance back into your portfolios. So there could be some shifts going on by the money managers as we evaluate this. When you look at the right side of the screen, it breaks down the large cap versus small cap. Who was the big winners earlier? Was the large cap. But what happened in the fourth quarter? We saw a major shift where now the small cap companies are now starting to outperform and again bring balance back into the market. Again, all this is to show you what's really going on and why you need to be diversified in the market moving forward. And one of the questions we keep getting asked is, well, but aren't stocks overvalued? Should we be in the stock market? Well, this again is giving you a picture of the PE ratios of the S&P going back to 1990 through 2020. And what you can see here is in the year 2000, the big 5 tech company PEs, if you look at the red box on the left, their PE ratio of the top 5 tech companies in 2000 was 60.4. That's huge versus the other 495 companies, their PE ratio was only 21 price to earnings. So what this is telling us is that those companies probably were in a bubble when their price to earnings is a 60-point factor versus the rest of the S&P 500 was only at 21. So they were overvalued. That's what caused the tech bubble and the tech .com, what they call the .com crash back in 2000. So it didn't affect everybody as much as it affected the .com companies. But look at those PE ratios in relationship to where we're at today. So in November of 2020, the top 5 tech companies, their PE ratio is only 32.2 versus the rest of the S&P, which is at 25.3, much more in line than what we saw back in 2000 with the dot-com crash. So we believe that the valuations are elevated, but nowhere near the bubble territory that we saw back in the dot-com crash. And if we had it on here, it would show you that historically, the average for the S&P runs around 18 to 20. So we're not that far overvalued relative to price versus earnings on the S&P. Another reason that stocks, we believe, are not that expensive moving forward is when we look at the stock prices relative to bonds. As Dan alluded to earlier, we are in a secular bear market for bonds. And if you look at the bond yields from 2006 through 2020, for the last 15 years, bonds really have not given us much of a return. In fact, they were negative in 2006, and they have turned positive as the economy improved after the financial crisis of 2008 and 2009. But returns of 1 to 1.5% are nowhere near the historical average of 4 to 6% expectation on the yield on a bond. And we believe that's going to stay that way. And again, another reason that stocks, while overvalued from a price earnings standpoint, may not be relative to other investments and asset classes out there. So again, looking at returns from fixed income, when we look at what happened in the last year, we did get positive returns from TIPS, US Treasuries, corporates, the overall aggregate US bond market. Globals had a good return. Emerging markets had positive returns, and even high yield have positive returns between 6 and 8%. However, let's explain why the bonds rallied in 2020. Look at the note on the left. It's because the Fed stepped in, dropped interest rates, and then started a bond buying program. This was new to the markets, and it bolstered the bond market and upheld it at a time where there was a lot of uncertainty in our stock and our equity and bond markets. So the Fed seemed to have done the right thing to prop things up to help us when we were shutting down companies and closing businesses due to the COVID environment and trying to contain the spread of the virus. So overall, we saw a positive year. And even though we saw this in these bond prices, we're not expecting that to continue because the Fed will have to start selling off those assets as the economy gets stronger. Okay, so when we look at the pandemic-induced shutdown that really created the worst recession since the Great Depression, and look at GDP, if we look at the blue box, the United States real growth, what we saw in 2019 was 2.2%. However, 2020, because of COVID, we basically lost and went negative in our gross domestic product for the year of 4.3%. However, what our projections are moving forward is that we have a pretty good, robust growth possibility here of about 3.1% is what the economists are telling us. When we look at the Eurozone, the green box, you can see a similar situation. They were slower in 2019. Why we told you, for the past year or two, we are invested primarily in the US because we have the higher growth. But look at what happened in Europe due to COVID. They went down twice as far as we did in economic growth and activity. They lost 8.3% year over year. However, they're expected to recover quite well and actually potentially outperform us per the economists. One of the reasons Dan touched on that we are going to be looking at more international as bringing some of that back into the portfolio for 2021. Again, the money managers are evaluating this and moving forward. Emerging markets, the light blue box on the right, they were robust in 2019, 3.7% growth rate in emerging markets, gross domestic product. They dropped significantly too, 3.3% in 2020. However, Again, 2021 looks like very robust opportunities for growth. So we want to participate from an investment standpoint in these market growth opportunities going into 2021. And that kind of covers it for me on the key themes for the markets. Dan's going to come on and we're going to be talking a little bit about the portfolios and how that plays out. But what do you think about the overall market trends and the opportunities we see moving forward?
Yeah, well, it's really interesting. And this is where, when you're looking at portfolio management, and one of the reasons why we keep saying tactical, tactical, tactical. Because at the end of the day, you're going to have different aspects of the market that are going to do well, others that aren't going to do quite as well. Now, you have to have some kind of structured portfolio. That gives you a little bit of a base in the growth of the portfolio. But if you're not tactically minded when it comes to managing the portfolio, you are going to find yourself lagging in the overall returns, because you'll be participating in the losses as well as some of the gains, which is more designed like a structured portfolio. So with our firm, you're going to find that the majority of the portfolios that are being used are more tactical, and we look at outside investments to really balance it out. So let's talk a little bit about the key things in the portfolios and moving forward. So now, Rocky really talked about the market. I'm going to talk a little bit about the portfolios. When you think about it, is it time to rebalance? Well, Rocky kind of showed you the fact that the markets were a little bit biased as to what was going up and what was going down, which does create an imbalance in portfolios. So it's very important to be rebalancing. We'll also look at the opportunities in the risk in the market. Opportunities often bring a little bit of risk. The question is how much should each client get? And we'll talk about that. And then the long-term investing principles. Well, if you think about it, we've said it over and over and over again. There's really three key principles. You want to own equities, you want to stay diversified, and then rebalance, rebalance, rebalance. So it's a investing principles that we believe in and have been working towards in every cycle, and you'll be seeing it moving forward as well. So let's talk about the time to balance. In this chart, you basically have two different aspects here. So your portfolio may be overweight in U.S. equities and riskier bonds. Now, why is that? Well, again, as Rocky pointed out in the previous slides, U.S. equities did very, very well. That being said, it kind of pushed the portfolio. But guess what else is happening? You've got moving forward non-U.S. equities that could be pushing forward. And in that, how do you keep your portfolio balanced? Well, we've got to work with the money managers in doing so. If you look at the MSCI ACWI, which effectively is the global equities index, it's a little bit more out of balance. If you were trying for, let's say, a 75-25 split in the portfolio, as different sectors start moving forward, you start seeing an imbalance occur. And this is where we're going to be working towards getting it back in shape. So if you look at the right side of the screen, you've got your average allocation to riskier bond categories. Now, we've talked about this over the last couple of years. How do you get additional yield out of the portfolios? Well, part of it was moving to more riskier bonds, being very selective with what we pick, but we were moving that direction. And the reality is they performed very well over the last 3 years, but you can see based on the growth that it is creating a bit of an imbalance in the portfolio. Again, this is the reason for rebalancing continuously. Now, this is kind of a complicated stock, but what we're looking at is international stock opportunities out there. We talked about risk versus opportunity. The reality is, if you look at 2020, there was a lot of risk in international stocks, and it certainly played out that way relative to the returns. But we also have a lot of tailwinds that are moving forward for the international stocks. What this graph really shows you from 2011 all the way to 2020 is the different areas, the number of the top 50 stocks each year by company location. In other words, where were they geographically? And you can see that every year it's just a little bit different. Emerging markets in some cases were really heavy where the US was low, and vice versa. Where we are currently is, emerging markets a little bit less than the US. You've got your developed international, and where's most of the growth in 2020? Well, it was China. But again, everything changes. If you went back to 2012 or 2014, you would see that China didn't do a whole lot at that point. So it's always looking at the market from a tactical standpoint and making the adjustments on an annual basis. Let's talk about fixed income. When you're looking at balancing higher income needs and volatility, the first thing I want to talk about when you're looking at these slides, again, we've got two separate slides. You got the bond sector yield and correlations to equities on the left side. So you've got the y-axis, which is hedge adjusted yields, and then on the x-axis you got the correlation to the S&P 500. You can see the US aggregate and the global aggregate where it is, and then when you're looking at the correlation, you've got 0.2, 0.4, 0.6, all the way up to 1%. And you can see that the high yield, even though it's given a higher rate of return for you, it's getting closer and closer to the equity exposure from a volatility standpoint. So ultimately, you've got to be able to balance that. You want the returns, but you don't want the overall risk. And we're going to be looking at those as we move forward as well. Core bonds during varied interest rates. This is an interesting chart because you got 4 different time frames where it shows you how the interest rates from a Fed funds rate performed and whether the Fed funds were going up or down at any given time. So you can see from 2003 to 2006 in a rising Fed rate, interest rates were lower. When the rates were flat from 2008 to 2015, well, the bond rates stayed pretty steady at that point. Then you go to 2015, 2020, where you have a bit of a rise and then a drop back down, and there was a little bit of a mixture, but still, all in all, about 4% over that time frame. And then all climates from 2003 to 2020, 4.2% overall. What I want to point out, though, is when you're talking about creating a portfolio, when you're talking about getting income from a portfolio, there are basically 2 ways to do this. Traditionally, you can pull it out, but there is a challenge there from a tax mitigation standpoint. In other words, if you're locked into bonds, it's very difficult to really exercise some paring off of gains against losses, which is proven to be about a 1% net gain for clients when you can do that. If you have to hold on to the bond, it becomes a lot more difficult to implement that strategy. The other aspect is when you're looking at dividends, dividends are always, well, for the most part, ordinary income. Whereby capital gains gives you a favored rate, or at least right now it does. So there's some challenges that go on with if only having a bond portfolio to get interest. And if we are heading into high tax rate environment, that might not be the place that you want to be to derive your income. And again, for the most part, for our clients, that's not how we go about doing it. We want to take a much more efficient stance in really driving income out of a portfolio from a tax mitigation standpoint. I love this chart. Why do I love this chart? Well, it kind of tells you in a snapshot the fact that the markets are very unpredictable as to who's going to be on top and who's going to be on bottom. So this chart shows you on the very top the dates, from 2007 to 2020. And then on the right side, it gives you the key, which shows you a color coordinated with an asset class. And as you can see, there's not a whole lot of reason or rhyme as to who's on top in any given year. But I think there's something else that's very key here that you need to understand. If you invested in the top asset class of the previous year, and that's where you wanted to put your focus, what you would find is most of the time, you're actually going to have a loss in the year coming up. Now, why is that? Because a lot of the times what happens is the high flyer of the previous year becomes the dog of the next year. So if you do this conversely, though, let's say you were in asset classes that were just doing nothing but killing it all year long. At the end of the year, you switched your asset classes to the worst that performed the previous year. You can see the bottom chart there, worst asset class. You can see all but 1 year, you would have had stellar returns. Now, this is really what we call contrary investing. Now, it's a little bit more risky to do it that way, but you can see that just holding on to what worked last year is not necessarily going to be the answer to what to hold on to this year. That's why it is so important to have institutional money managers managing the portfolio, because if we held on to a high flyer thinking it was going to go up again the next year and it dropped 20, 30%, well, I think we've all been there. It kind of really deflates you when you think you had it all in the bag and then it was taken away. So institutional money management is very important to keep us on track. Now, let's take a look at diversification. We talked about diversification is extremely important. It's a powerful tool to navigate through the markets. And what you have here is if you had invested $10,000 at the end of last year, where would you be at the end of 2021 based on 3 different type portfolios? So you've got global equities, that's 40%, with global bonds at 60. And then you got global equities at 60, bonds at 40, and then all equity global market. And you can see the more you get into equities, the green line, you have a better chance of a larger downturn. In this case, it was almost 32%. But you can also see it bounced back pretty fast, and it's also the leading portfolio. But you've got to be able to handle the risk. That's why many people want to stay a little bit more diversified. Let's say a 40-60 portfolio, the blue, where it didn't go down anywhere near as much, but it's also not as high at the end of the year. So diversification is extremely important, and that's one of the hallmarks of what we do for our clients. So we're going to get into a little bit more on portfolio development, which Rocky's going to talk about. If you recall, last month on 12/17, we did a portfolio engineering, a goal-oriented portfolio video, which you can go back to YouTube and take a look at to get a bigger picture. Rocky's just going to touch on the key points in this area. So, Rocky, you want to go ahead and take over?
Sure. So what we're going to start with is kind of what is that framework for portfolio development that we have? What's our process to achieve your goals? And how it's divided up is what does the portfolio manager do and what does Daniel Krug and Associates do? And that's kind of, you see the blue line separating these different sections. But let's start at the top. Here's where the process starts. It's with your asset mix. Okay, what is that stock and bond strategy? And each portfolio manager starts here. What am I trying to do with an overall strategy for this portfolio that I'm going to construct? Okay, what is the mix of stocks and bonds I want in it with an overall target rate of return. From there, they move down into, okay, what's the equity mix that I need inside of that portfolio? Do I need large stocks? Do I need small stocks? US, international, growth or value? There's many different types of stocks out there that have different rates of return, different risk associated with it, different volatility, some that do well in certain market conditions and some that don't do well in certain other market conditions. So they're looking at what's the right mix that I need in these sectors to reach that stock and bond strategy I'm putting together. After they've got kind of the equity mix, this is where they really got to dive into the deep fundamentals of specific companies as far as what's their stock valuations, what's their bond ratings, what things are going on within that company that makes that fundamentally a viable option to put into the equity mix of the portfolio they're constructing. And so their focus there, stocks and bonds, what's the right mix to hit these goals? What Dan and I do, and what we do at Daniel Krug and Associates, is now we vet these money managers. And we do a lot of this research with the aid of a company like AssetMark that really can present a lot of data. They actually visit these companies. They actually talk with the money managers on an ongoing basis. They actually track them to their targets and hold them accountable to what they're doing and know internally what's going on with these money managers. And from there, we are kind of vetting with AssetMark and making manager selections on, hey, who's a good equity manager? Who's a good bond manager? You know, who's got a good niche and track record and performance in specific niches of this portfolio construction that's going on. And then what we do is not only select those managers and customize a portfolio to reach your goals, we then have to make sure that we are constantly rebalancing that mix, looking at the taxes and how to harvest those taxes to mitigate long-term taxes in your portfolio. And one, based off of your goals and needs, what timing is going on? Is it time to start shifting away from a certain manager portfolio mix based off of changes in your life over time? Specifically, think of somebody that's been working and managing for growth for a long time, and now they're going to retire and they're going to need income out of that portfolio. We've got to re-change that portfolio construction to meet those changing goals as we move forward. So this is kind of like the framework of the portfolio process that is going on. And then what we want you to do too, because there's been a big shift in the last several years since the 2008 market crash and financial crisis. We've really been in a low interest rate environment. So the old stock and bond portfolio, when the bonds were producing an average of 4 to 6% rate of return, and we were using stocks for the growth portion of that, we've really got to rethink how we are going to put these portfolios together to either create growth or to create income, or both growth and income, which is the need of many people today. So it starts with looking at dedicated growth strategies, and that's where your portfolios are designed around U.S. equities, large, small, and mid-cap companies, international, developed and emerging. What if it's more of a growth and income strategy? We've got to bring in some high dividend and income equities. Again, the bond market, as we showed you before, a return of 1 and 1.5% is basically where we're at right now. That doesn't meet even the need to maintain inflation, with inflation being around 2% right now. So growth and income, we've got to introduce high dividend and income equities into the portfolio to bolster that income side of it. And then there's opportunistic income. And I'm not going to go into a lot of detail on that. Go back to the last engineering the portfolio, and we got into a little bit more in that video presentation. Safety of principle. This is where, hey, I'm don't want a lot of risk. I want to maintain what I've accumulated, and that's getting into some of our core fixed income strategies. And basically, in this area, you are using a lot of bonds, but where the strategy has changed is these bond managers are more actively trading to make that portfolio give us a return. You can't just buy a bond and hold it for the next 10 years. That bond is subject to a lot of volatility based off of interest rate changes, what the Fed is doing, and what's actually happening in the economy. So they are constantly tactically managing those fixed income portfolios to protect your principal. And then there's alternative investments that can give us a little bit of juice in additional income or additional growth and return or in further diversification. So there's a lot going on, but we want you to think of things a little differently. Instead of thinking of stocks and bonds, think of what are my sources of returns that I'm getting and where am I getting them from? So that's a little bit of a change, but that's what we are doing at Daniel Krug and Associates. Again, our money managers, they're focusing on high quality companies, and this chart shows why. Everybody wants to talk about the dot-coms or the technology, and because of COVID and the push for vaccines and research and development, there's a lot going on. But when you're talking about your portfolio, you don't want to rely on high flyers or speculative stocks. Not saying they're not in it, but if you look at this chart, where has profitability basically come from? It's come from the evolving consumer trends, digital revolution, and healthcare, but not in the speculative emerging technology as you see on the left side of the screen. And also, when you think of not only where did the returns come from, but what is the price you're paying for that? That's the valuations on the right side. You see that speculative emerging technology is very, very expensive to own. So you've got the combination of very expensive to own with also many of those losing money over time. It's interesting, if you talk about Tesla, Dan, you see that its stock has been going crazy, and it is in the portfolio in small amount. But again, they have not had a profitable year. They've lost money every year. So when you look at the valuations, you got to be very careful what you're paying for when it's your money and trying to grow it over the long term. We have processes and history to go by to say, here's how we're investing and why.
Yeah, that's why diversification is so important, because again, you're going to have companies that are going to look at these speculative companies, but they're going to be in a small amount just to give a little bit of juice to the portfolio, and they are going to vet the heck out of them. So you're right, Rocky. This process works. It's worked very well over the years for our clients. But let's take a step further. I'm going to go into the 3 levels of portfolio management that we have. So when you're thinking about the market and what's going on, and people are worried about sell-offs, and we've said this before, do you need to be worried about it? No, not if you have a plan, and we have a plan. We have short, long, and contingencies. So there's a lot to what we do here, but let's look at the plan. When you're talking about looking at the portfolios, everything that we've talked about with the sector changes, the lagging and then the leading different asset classes, the first part of the strategy really works with the money managers, the institutional money managers, where they are actively managing the portfolios, reallocating the sectors. So that's the first one. The second one, when you think about our passive managers, and we're talking now about more structured portfolios, they're already balancing the portfolio or rebalancing back to the target rates for each one of the asset classes. So that's the second area. But the third area is really where our firm rebalances your family of portfolios back to your personal risk profile. In other words, if you have, let's say, a fixed income portfolio and an equity portfolio, which one do you think really worked out better in 2020? Well, equities, right? So you can anticipate the equities to be a bit out of balance. So one of the things that we're doing this quarter is we are going to be rebalancing your family of portfolios back to your risk tolerance. So if we do have another surprise drop in the market, your portfolio's risk profile will be really coordinated to what you can expect to happen in a market correction. Nothing more, nothing less. And ultimately, as we move forward, we will continually rebalance your portfolios. So it's a lot that we've covered today. At the end of the day, many people say, well, tell me more. I would kind of point you to our YouTube channel at Daniel Krug and Associates YouTube. There you can see all the different webinars we've done on the different subjects. For the most part, they're broken down into different segments, so you can kind of take them a bite at a time, if you will. There's a lot of different subjects out there that we talk about, and a lot of information for you. For that, Rocky, do you have any last thoughts?
Looking forward to 2021. People are asking, and like you said, it comes down to, I hope we showed you that there's growth projections for this year. People are really concerned with all the changes and with COVID still going on. But I think with the vaccine and the desire to get the economy going, I think that we're going to see some good returns in this year too. Notwithstanding volatility, we will have those periods. We do expect a market correction or two. So you heard it here. Don't have one.
Yes.
We haven't had just a true correction. Last year was COVID shutdown. That was a black swan kind of event.
Yeah, self-induced.
So, make the plan line up.
Yeah, it's like we always said, we're a tactical firm in everything that we do, whether it's investing, tax management, estate planning, charitable giving. It's tactical. Everything's tactical because the environment around us is constantly changing. So you have to be able to adapt. You'll perform better if you do. And that's why we've taken that philosophy with really everything that we do for our clients. So that being said, we're going to move on to the end. So, as we've always said, there's really no need to worry. You take care of your family and we'll take care of you. We're ready for 2020 and beyond and looking forward to seeing all of you back in the office.
Goodbye, everybody.